Welcome back to another Solus financial module where today we're going to be talking about investing and how you can make money work for you instead of you always having to work for money. Let's get into it. Investing versus gambling. Gambling is emotion driven, short term focused. There's no edge and you're just hoping to win. But when you invest, it's probability based. And if you love probabilities, it gives you an advantage because if let's say for instance a batter. In baseball, a good batting average is 300, right? So say you as an investor, as a trader, you go up to the plate and you miss 3 out of 10 times. I'm sorry, you only hit 3 out of 10 attempts. That is pretty good odds. I mean, it's pretty good as long as your losses are calculated and not too big. That's why we go into risk managed and expect volatility. What investing really is. Investing is allocating capital today to receive more capital tomorrow. You're buying cash flow, ownership, and future productivity. We don't buy hypes and headlines and hot tips because those are all emotion driven and we want to build consistent cash flow, ownership, and future productivity. The core asset classes, stocks such as Nvidia, Apple, Microsoft, any other ownership in companies, ETFs, which is a basket of stocks like the S&P 500, then real estate, physical property that produces rent or appreciation, and then private businesses. Risk versus reward. Amateurs ask, how much can I make? Professionals ask, how much can I lose? So risk is volatile, uncertainty, and permanent loss of capital. High reward usually means higher uncertainty, longer time horizon, and higher emotional pressure. Pros think in probabilities, not predictions. So long-term investing versus trading. So long-term investing is years to decades. So 5 to 10 years, 10 to 20 years, 30 to 50 years. But it compounds your focus and it's lower stress, and it's probably a simple way of building wealth. Now, trading is more short-term and it's more income focused, right? So trading can provide cash flow, investing can provide wealth. Both of them combined together builds. I'm gonna let you finish that. So compound interest, the real cheat code. Compounding interest is returns, earnings, returns. So say for instance you put in $100. That $100 returns another $100. Now you got $200 and it just keeps compounding, right? So for example, we have here, so $10,000 at 10% annually becomes at year one, $11,000. At year 10, it's $25,000. See what I'm saying? The compounding just keeps compounding. So why most people lose their money is because their emotional decisions, they're following hype cycles, or they're over leveraging and they have no long-term plan, and then they just quit. So capital allocation is deciding where to put your money, how much to put, and how long to leave it, and when to rebalance. Good capital allocators, like here at Solus, we think in percentages, we manage downside, and we preserve optionality, and we stay liquid when needed. Now, staying liquid meaning having cash on the side to be able to hop in on opportunities that we see. Think of every dollar as a soldier, not as a piece of paper. The wealth framework: income into savings, savings into investments, investments into compounding legitimacy of freedom. Now, the final principle of this: investing is not exciting, it's boring, and it's methodical and it's thought out, but it builds patience, it builds discipline, it builds risk control, and it's long-term thinking. Now, once you can master where to put your capital, money stops being something you chase and becomes something that works for you. So instead of you having to chase after the money and go and work to that 9 to 5, you then have the money working for you and you control it. If this module was helpful in understanding that investing is not all fun, it's just boring and methodical, but it allows us to build our freedom and for the future. Let's hop into the next module where we then talk about protecting our future wealth.